morning, everybody. It's very nice to see many of you here, many familiar faces here. And I just wanted to welcome you all for this next session on how financial inclusion has enabled economic opportunities. I think it's very nice for us to be focusing on this topic as our first panel discussion on the deep dive research that we've been conducting. Because after all, often when we talk about finance, we talk about the extent to which people are included, whether they have formal accounts, and so forth, but we don't perhaps pay enough attention to the role of finance in inclusive growth and in enabling opportunity for households and MSEs. And that, of course, is why we have the financial sector in the first place. That is precisely the role that the financial sector has been put in place to achieve. So I think it's very appropriate that we are focusing on that to start with. And I think our recent data on financial health has also called into question, really, the value of financial sector growth in terms of these ends that it has been set up to achieve. So I'm not going to go into great detail on this session, because I really want us to get started with the presentations. We've got some very, very interesting papers which we're going to be presenting today. And we have some very, very expert researchers who've been digging into the data and really mining FinAccess data in a way that we have not really previously done. So whereas we've had research papers in the past, the objective of these papers is really to focus on research for policy. We wanted to use the data to mine it deeply, to derive insights that could actually really inform our development and our policy decisions as a country, both public sector and private sector. And that's why we commissioned the papers that we did. So they're sitting at that cusp of research and policy. So I just want to briefly introduce the three papers that you'll be hearing this morning in this morning's session. The first gives a sort of, perhaps I should say, an overview, a bird's eye view of what's been happening since 2006 in the financial sector and also in Kenya's economy more broadly. It looks at trends in livelihoods, in well-being, and how these have interfaced with Kenya's financial inclusion journey, which has really sort of expanded during that period. And I guess ultimately it's asking the question is, what has that amounted to? How has Kenya's financial sector development really been instrumental in supporting the kind of development that we're seeing? And where can it also improve? Because in fact, in recent times, we're actually seeing a decline in many of those metrics, which the paper will go into. A second paper, and that paper is being given by FinMark Trust, our sister organization here at FSD. In fact, FinMark were the originator of the FinScope surveys, and so we actually owe them a lot, because the FinAccess surveys since then have really added so much to our knowledge across the continent. So we have Bobby Berkowitz from FinMark Trust, who's a senior analytics specialist, and he's come in from South Africa yesterday to present for us. And he's joined by Tabitha, whom we've already met this morning, who's the head of financial statistics at the Kenya National Bureau of Statistics, Tabitha Mwangi, and by Carol Matiko, who is the research director at G. Morich Consulting, and who has also worked for many, many years on financial data and is an expert qualitative researcher. Second paper is going to take a much closer look at particular livelihood segments. And these segments have been identified because they should represent low-hanging fruit for the financial sector. They should, they're segments which have been chosen because they have slightly higher incomes or they have a larger size, and therefore they really represent a financial, an opportunity for private sector. But the question that we're asking is, to what extent have their needs been met? You know, are these segments still having unmet needs that could be better served by the sector? And so we have Jess Robey from 71.4, which is, again, a data science and analytics firm from South Africa. And 71.4 is sort of, its niche is really mining data to derive insights for policy and market development. Jess is a consultant with 71.4, and she will be presenting this segmentation analysis. She's also worked closely with us previously on MSE data and a previous round of the same segmentation for the 2019 survey. And then the third paper is on, in fact, it's our very own, really, because it is on an MSE Tracker survey, which we put in place. It was the first tracker survey that we've done under the FinAccess suite. And we put this tracker survey in place during the pandemic to see what's been happening to MSEs during the pandemic. It was really stemming from a conversation that we had with the governor where he said, I want FinAccess to be useful for us in, in supporting policy during this critical time of the pandemic. I want it to provide useful information for decision makers. And that kind of inspired us really to put in place this tracker survey on a very important population, which is small and micro enterprises. We already had a number of household trackers around, but we didn't have a bespoke tracker on that very crucial segment. So Tabitha Mwangi will present some sort of data from the tracker survey, but she will also make the case for why tracker surveys are important. After all, we have data on MSEs in the main FinAccess survey, and it's very detailed and rich data. But what we don't see, we have data from 2019 and 2021, but what's happened during that time? Why have we seen a decline, for example, in people being able to derive their livelihood from MSEs? So she's going to talk about the importance of tracker data. And that's the three papers that we have. And so for now, I'm going to hand over to Bobby, Carol, and Tabitha from the FinMark Trust team. And I'd also like to invite Jess, please, to come to the stage. So maybe all of you could be seated and then take your turn at the podium to give your papers. After which we will be inviting the moderator for the panel discussion, Amsat Zawere, together with two panelists who we have with us today, Peter Juguna from Sazra, and Duritu Muridi, who's an economist who's also joining us today. Thank you. So I'd like to, without further ado, hand over to Bobby to take us through the first paper.
Thank you, Amrik. And thank you for having us. Welcome to distinguished colleagues in our financial inclusion community, and I'm hoping that all protocols are observed. I'm really pleased and excited to be part of this landmark event. The FAM partnership between CBK, KNBS, and FSD Kenya is showing, I think, all financial inclusion champions across the world how to collaborate and innovate on financial inclusion research. And earlier this year, we've already seen this recognition given by the Alliance for Financial Inclusion. The partnership actually presented a case study that I think is an inspiration for other members of AFI. As Amrik mentioned, I'm from FinMark Trust. We are a sister FSD to FSD Kenya. It's my second time actually here at KSMS. The last time I was here was, I think we would all call it now before the COVID era, and it was in preparation for the 2018-2019 FinAccess study. CBK organized a special session for the regulators to introduce to them and to inspire them in terms of how to use financial inclusion data for monitoring and for targeting their own policies and how they can actually have a financial inclusion focus. And we were part of sort of sharing that data as part, other colleagues from the ITI facility we hosted at the time. So what I'm going to do over here, as Amrik has said, is I'm going to talk about the entire sort of timeline of FinAccess to see when it comes to key measures. And some of those measures are actually welfare. They are financial health measures, proxies for for different dimensions of financial health, as well as different areas of financial inclusion and how these have changed over the period. What is really key here is the 2016 year. Everything hinges around 2016, and we're going to see this through all the data that we look at. What we can see here when we're starting off, this is looking at a couple of measures of welfare. We can say proxies for financial health. In blue, we've got food poverty, the proportion of Kenyans who often or sometimes go without enough food to eat. And in yellow, we've got the median personal monthly income. We can see actually from 2006 And particularly since 2013, there was a significant improvement on both these measures. The proportion of Kenyans experiencing food poverty pretty much halved in this period, and personal median monthly income actually went up 50%. So a tremendous improvement, particularly 2013 to 2016. However, since then, in the last 5 years, we've seen declines on both measures of food poverty as well as on measures of median personal monthly income. Other measures of welfare, or let's say financial health proxies, one over here is the ability to access a lump sum in a short period of time. The other is perceptual, whether Kenyans say that their financial situation has improved in the past year. And again, since 2016, these are really dramatic declines on both these measures that we're witnessing across the timeline. So we're looking at all welfare measures declining since 2016. And again, 2016 is this pivotal hinge. There's improvements before then, and there's dramatic declines in welfare since. We now are turning to different measures of financial inclusion. Here we're talking about traditional finance. So we are seeing traditional bank accounts, chamas and SACCOs as all examples of traditional finance, let's say before we were seeing digital finance. And again, we see some improvements on these things, particularly when we're looking at chama uptake up to 2016. Of course, we have the sort of rise of mobile money, and obviously Kenya is synonymous with that. And we can see, as mentioned, mobile money was launched in 2007. The first survey that covered mobile money was in 2009, and there's a dramatic increase in mobile money uptake. But since 2016, in terms of traditional finance, we see the decline in traditional bank account uptake. We see the decline in chama uptake. But we still see mobile money expanding, although most of the expansion took place before 2016. Now, mobile money is really synonymous with remittances. That's the sort of key use case. I'm not showing remittances here. That is very high, that is very close to the overall mobile money throughout the period. What I am showing over here is digital payments. Separate from mobile money, this is when you're paying for bills, fees, or taxes digitally. And here we can see that, again, in this period, a dramatic increase from a very low base. But since 2016, it's actually a use case that is becoming almost synonymous, or in the same way that remittances have been with mobile money. And obviously, we know that the pandemic era was a key aspect for changing digital behavior and around payments beyond remittances. Other things that are sort of pivotal and key in terms of increasing across that same period are digital savings, and that you can see in this orange line, and digital credit, also expanded since 2016. And then we've got, beyond the overall uptake, we've got other measures of traditional finance. We can say traditional formal savings, traditional formal credit, informal savings, informal credit. So between 2006 and 2016, there were declines in informal borrowing, uptake, expansions in informal saving. Since then, we've seen the digital credit and digital savings rise. At the same time, there's a rise on the left, as you can see, in informal borrowing, while traditional formal savings and informal savings have both declined since 2016. In the last session, Mary was talking about some pivotal research that showed very strong welfare relationships between digital finance and these key measures of welfare. So I'm repeating some of the findings that Mary was alluding to. I'm just showing the sort of key papers. And these are key papers for Kenya, but they also are key papers for demonstrating the digital financial services use case for the world. And what we see here is the strong relationship with digital financial services and consumption, self-employment, income, helping people dealing with shocks and being more resilient. What's important over here, as we can see, is that most of these papers are from the period before this 2016 hinge. So a lot of the research is happening at the time that digital finance has expanded, but so has welfare overall, whether it's connected to digital finance or separate. So we want to focus on the 2016-2021 period because it's actually under-researched, and it's at a time when there's been a lot of declines compared to the previous period. What is different with FinAccess is a cross-sectional landscaping study. So it's not set up for experimental research. A lot of these papers actually had an experimental design. FinAccess doesn't have that. But FinAccess does have data, and rich data, and as we see from 2021, county-level reporting data that does allow us to do different things. We've applied some econometric techniques over here to come up with what we call a kind of quasi-pseudo-panel to look at things. And again, we're reporting in each of these columns on different measures of welfare, or let's say financial health. We've shown food poverty, being able to raise a lump sum, a financial situation having improved. And we run different models to look at those relationships with financial inclusion. We hold other demographics constant to see what those impacts are, and also where we can actually control for them and then look at the partial effects of financial services. And things on the demographic side make sense. So people that live in a rural area are more likely to experience food poverty. People from higher education levels are less likely to experience food poverty. People from higher education levels are more likely to raise a lump sum and say that their financial situation has improved. What is very interesting is there's a negative relationship between digital finance, and particularly between digital savings and digital credit, and these welfare measures. Food poverty, raising a lump sum, financial situation having improved over the past 5 years, the 2016 to 2021 period. Now, this doesn't mean that digital finance causes negative welfare. When we've actually looked at it in more detail than what we think is going on, is that digital finance has actually led to accessibility and product development for people that are vulnerable. And vulnerable people, as we can see en masse, are facing difficult times between 2016 and 2021. They're facing difficult times, and they also have access to products that allow them to better weather those difficult times. So in terms of the design of our models, let's say that we have two similar people. Let's say we have two 23-year-old men from a rural area, and that they both have secondary level education, and that they earn a similar income, or let's say even the same income. So we control for all those things. If one of those 23-year-old men is experiencing food poverty more frequently, that man is more likely to have digital savings or digital credit. And he's more likely to have digital savings and digital credit because he's able to access those things, and they're helping him deal with his liquidity and resilience issues. So these are very interesting findings, and it's important to see how the causation works. People are getting into these difficult welfare situations, and there are products that they can access, digital products, to help them deal with their, to deal and weather those storms. Now, I'm going to pass over to my colleague, Tabitha, my colleague on this aspect, who's going to provide us more insight in terms of the context in which we found these changes going on.
Okay, thanks, Bobby. So we want to look at the socioeconomic context in which this study and analysis is based. And I'll start with where Bobby had initially indicated on the issue of the reduction in the poverty. The poverty head count rate reduced from national 46.8% to 36.1%. But this reduction largely took place in the rural areas. So what it indicates is in urban areas, the reduction just, the people living below the poverty line only reduced to 29.4%, compared to a reduction of to 38.8% from almost 50%. Half the population in rural areas were living in below the poverty rate. So what underpins the improvement in welfare and decline in jobs? There are four broad drivers that we want to look at. That is the structural change, the composition of GDP. And the other element we want to look at is the demographic composition, that is especially the youth bulge, and a skill mismatch that may explain the situation. And then the other important element that has happened between 2006 and 2021, the period of we are reviewing, is the county government. County governments came into place in 2013 after the new constitution. So how is that a driver? And then the fourth pillar that you're looking at is issue of access to markets, local consumption, and the issue of what you're exporting. So in terms of government policies and coordination, with the evolution, some functions were transferred, or they became the main the focus of the county governments from the national government. And that transition period had some challenges in terms of roles. For example, especially in agricultural sector, like extension services, and also support offered at county level. The other element in terms of from a macro side is the issue of the fiscal deficit. And here we are looking at the indicator as a percentage of just GDP. It was a negative 0.4% to a high of negative 8% in 2021. And that has implications in terms of funding government functions and services it can offer in terms of development, the scope, how far you can go. The other thing that has happened during that period that we are focusing on is the issue of the cap in interest rates that happened. And you can see in terms of private sector credit and the government lending, that the private sector credit went down. Of course, there's that movement in the government borrowing. And what is observed is that there was some form of crowding. There's some form of crowding out of the private sector with government lending, which impacts, of course, on what the private sector can access in terms of loans, in terms of support from the banking system, for example. The other pillar we want to look at is in terms of our production, and especially the issue of the composition of GDP. The level of exports has declined from 27% in 2006 to 11%. This composition is important because our key exports, some of our key exports, they also drivers, or they employ a huge majority of the population, especially casual labor. And these are the key crops like tea, coffee, and the horticultural crops, sugarcane. So in terms of the key component of exports, when there's a decline in terms of productivity, of course you can see that there's a lower demand for labor, especially for that sector. So what is constant during this period is, of course, the private consumption that is driving the GDP, and which has been constant at around 75%, with minor changes during this period. So whatever we produce, the implication is that whatever is produced locally should drive the domestic demand, should drive the growth, is what is driving growth, and needs to be absorbed since there is a decline in exports. The structure, in terms of structural composition of the economy, there's a gradual structural change from agriculture to services. In 1990, for example, the share of agriculture was like 38%, declining to around 31% in 2018, and further lower. And also the composition in terms of employment. A lot of employment now, from 71%, for example, in 1990, 50% in 2008, to a decline to around 44% in 2018. We are focusing on this is what we're highlighting because Bobby will highlight again the other in terms of employment shares. And what it means is agriculture sector is not able to absorb all the labor, and most of the shift, especially for the unskilled and lower skilled workers, have to go into services, for example, in wholesale and retail trade, also in some part of industry which has grown to 19%, which grew to 19% in 2018, like construction and agro-processing. So that shift also explains some of the gains that are there in terms of welfare, and also constraints in terms of course, of the labor market in terms of earnings. There's a shift, yes, but what is the value of that shift, and what is the level of earnings that is there? Are they good enough to support our incomes, and of course the quality of the livelihoods in that form of earnings? So quality of jobs is lowest. Quality jobs have grown slowly, whereas the economy has grown faster. And in terms of employment, the significant growth is in the informal sector. And you all know that the informal sector is precarious in terms of the labor. There's lower security, is characterized by lower earnings, and of course the lower skilled population, which are the majority, moving in and out of sectors. And that is what we are seeing here. So for example, in 2006 to 2021, you can see the growth in the real GDP in terms of trillions to like 9 trillion. Whereas, and you can see the growth in the informal sector workers to 15 million in 2021. Whereas the formal wage, like the private sector wage employment, that is growing slowly. So what this implies is the economy, the employment, the labor market, our labor is structured in a way that most of the jobs created are in the informal sector. And whereas we have a lot of training happening and a lot of graduates, for example, some skilled, it's still low. So what we want to, what we are trying to indicate here is you can see the labor force participation rate. It has been growing, but there was a shock like in 2016 and that decline that has happened. So in terms of job growth, the number of jobs being created are not in tandem with the adult population growth. So if you reach 18 and you're no longer, for example, in college, you need to take up a job, which most of our youth don't transit to the higher tertiary level in terms of the number of people. So the labor force, the adult population, there's a gap between the adult population and the employment that is there. So you can see, for example, as we had alluded earlier, the growth in the informal sector to 15 million people from like 7 million people in 2006. This shows that the way the economy is, there's a labor issues, labor market issues in terms of what you're able to provide in terms of a quality job for the population. And this is important in terms of what we started with, that is coming out of poverty and staying out of poverty, and also having enough sustenance for both savings and for investment. So the other quadrant we want to look at is the demographic characteristic, how our country is. There's a youth bulge. So in 2021, and this is the share of the population that is aged between 16 and 25 was 34%, compared to like 28% in 2006. And you can see the lower pen showing in terms of the education level. So there's a higher increase in people who are going up to tertiary level, and also completing secondary school. Like for example, in 2021, 13% completed secondary. 36% have had a secondary education, 13% have a tertiary education. But that proportion of the population is not absorbed in the, what you could say, quality jobs, or the skills that they have attained are not being absorbed in the labor market. The other thing we just want to highlight is the issue of in terms of equality. For example, we looked at the competencies across, for example, various grades. You find like in terms of mathematics and science, the competency has declines. Like there was a research, this is a research on around 2018-19, that in terms of mathematics competency in grade 3, it was 59%, what you're supposed to know when you're in grade 3. But as you go forward in terms of Form 2, and that is grade 10 also, only 6% people have the competency, the Inform 2, of what is required for that grade. So it shows that you start well, but the skills as we advance are not matching what you're supposed to be doing, which of course has implications in the labor market. So the other aspect that is very important in terms of our livelihood is what we all are aware of, is the inflation. So here we have shown the movement in the trend in terms of overall average inflation and the movement in food prices. That is the food inflation. It's a roller coaster moving up and down of food, which is a major composition in terms of expenditures. Why does it matter? If the majority of the population are earning low wages, and there is no predictability in terms of food prices, or there's a high and up and down movement in food, it means that a lot of the population are living in precarious situations. Most of their money or earnings going into sustenance, food, and which of course affects how they can progress, for example, and move out of poverty, invest more in education, invest more in other elements. So this is important in terms, especially for the two dichotomies that we analyze, the rural populace and the urban. So whereas we measure these inflation numbers are, for example, urban-based, we collect prices in urban areas, the prices affect both the rural and the urban, because we also have rural connections. You know, the price in, for example, Nairobi or some areas, there's that minimum threshold that also is translated or is transmitted in rural populations. There's only so much you can grow. In terms of, you also need to buy some stuff. So the rural population is also affected usually by poverty, and also is a significant number of the population, which means that, therefore, that as much as there's this growth that we're experiencing, the rural population is hugely affected, and much needs to be done in terms of what financial services and inclusion can do for the population. So in brief, those are the four pillars that undermines this analysis that we're doing and driving decline in quality of jobs and the implications for well-being. Thank you. I would want to call Bobby to continue with the results from the analysis. Thank you.
Thanks very much, Tabitha. So I think with the context that Tabitha's provided, one of our key focus areas in this paper is actually on the livelihood lens and how this has shifted over time and what it means for welfare as well as for financial inclusion, and how at a livelihood level financial inclusion is assisting welfare. What Tabitha has shown is that particularly in the last 5 years, 2016 to 2021 period, there's been a lot of pressures on the economy that people are working in, and actually the labor market has struggled to absorb people, and it's particularly in rural areas. You can see that roller coaster of food prices in rural areas is actually saying that there's very little stability for people in rural economies, and if there's little stability for people producing food in rural economies, there's little stability for people working in rural economies, for people selling and trying to make business in rural economies, and it's very difficult. In addition to this jump in the population because of a youth bulge and an economy that's growing, but not growing in a way that can absorb that much labor that's entering it. And we see this actually coming in now with livelihoods. So in 2016, the average number of income sources for an adult Kenyan was 1.5. In 2021, it's now 1.2 sources. And actually, the sources that have been dropped are farming and small business. We saw the Juakali video going earlier on, and that is supposed to be a segment that can absorb a lot of people. But in actual fact, over the last 5 years, it's a segment that shrunk. In addition to more formal ways of people earning money, whether it's through employment or through formal businesses, we can see that farming is the proportion that are earning any money from farming and the proportion earning any money from businesses declined. And then on the other side, what's really swelled is casual work, because maybe a casual worker had their own business as a core income source. But now if they're only left with casual work, that is now their main source of income. And then, of course, a lot of people are joining the labor force, but they're not earning income and they're dependents. And we can see this when we actually look at it from an age perspective. So on the left here is the youth breakdown over time. In the middle, it's the productive age. And on the right, it's the older age group. And we actually really see that in 2021, the proportion of youth that are dependents has swelled. And the proportion of productive age that are casual workers has also swelled. A real structural change in the economy and in terms of livelihoods. The next thing that we are looking at here is the relationship between livelihoods and welfare. So the first thing that we've seen, we've already looked at the traditional financial uptake, and we've seen that there's been a decline. So now in 2021, Chama, traditional bank, and SACCO uptake is lower than it has been before. When we then look at livelihoods in 2021 on the bottom over here, you can see for Chamas, the segment that has the highest proportion of Chama usage are business owners. That is a segment that's declined, but it is also where Chama usage is high, and there's a reason for that. In terms of traditional bank ownership, the vulnerable segments, dependents, farmers, and casual workers, have the lowest uptake of traditional bank accounts, and unsurprisingly, wage and salary earners have the highest proportion of bank account use. They also have the highest proportion of SACCO use, where it's low for most other segments. In terms of digital finance, we saw this real increase, particularly in digital savings and digital credit in the past 5 years, so that half of Kenyans are digital savers, and a quarter of Kenyans have some form of digital credit. What happens here is that there's a relationship as we go along the continuum of digital finance. So most of the Kenyan segments have a high uptake of mobile money. It's dependents, and we've seen that dependents have been swelled by the youth that have the lowest. And there's a similar situation in terms of digital savings and digital credit, and obviously it is a proportion of overall mobile money uptake. What's interesting with digital credit is casual workers have a higher uptake of digital credit than we'd expect from their other digital finance uptake proportions. And finally, with welfare, we've seen all welfare measures declined. So in 2021, only 8% of Kenyan adults have the ability to access a lump sum in that period of time, and half of them are experiencing food poverty. On food poverty, most segments are quite high. Employment has the lowest, but even then, 1 in 3 wage and salary earners say that they often or sometimes experience food poverty. In terms of ability to access a lump sum, hardly any of the vulnerable segments can. And of course, wage and salary earners, 1 in 4 of them can. And then, we took a growth measure, let's say, in terms of people's personal monthly income. It's low for most segments. Even for wage or salary employment, a median of 15,000 shillings is much higher than the others, but the own business segment, that has dropped a lot. So that now in 2021, it's a 6,000 median personal monthly income. And then the next one, wage and salary earners, is 2.5 times that amount. So we did some other econometric work now when we're going down onto the livelihoods level to see the relationships between welfare and finance. And of course, in terms of food security, savings makes a big difference. But the biggest difference is made by SACCOs and banks. And we've seen that those don't have the highest uptake, and unsurprisingly, there is a bias towards wage and salary earners when it comes to SACCO and bank uptake. Digital savings and mobile money does make a difference. It has a lower impact than SACCOs and banks, but of course, the uptake levels are much higher, so many Kenyans are benefiting in terms of food security from the digital savings. When it comes to the income, the sort of growth measure proxy, bank uptake's got the greatest impact. Of course, again, wage and salary earners are the ones that really have that high uptake and benefit. Chama uptake is another one, and there we saw that small business owners have the highest Chama uptake, and that leads to improved income, although the impact is smaller than banks. I'm going to hand over to Carol now, who's going to expand on some actual stories of people and interviews that were had.
Thank you, Bobby. So this qualitative complements what Tabitha and Bobby have said, and the qualitative assignment was basically to try and understand at what point do financial services support accumulation and growth. And in terms of the approach, it was based on looking at the livelihood journey of a selected number of respondents. So one of the things we found that there's other underlying factors that will influence whether or not one can actually harness the most in terms of these financial products. And that's education, social support, and obligation will determine your livelihood trajectory. And this is best illustrated by two livelihood journeys. Both ladies have certain similarities. Both of them worked in casual work at one point of their life. So we start off with Cynthia. Cynthia completes her secondary school in 2012. She's not able to proceed with college because her parents then decide to prioritize her siblings. She wanted to be a nurse. She specifically says that they prioritized her brothers. She then starts engaging in casual work, and this casual work involves construction, but also daycare. Of course, she gets M-Pesa, she has a home bank, and she gets married in 2014, has a child. And I think what is unique about her, because she has the support of her spouse, she's able then to leverage on chamas where she saves in a chama that gives her ×3 and a Roscar, and opens her own salon. She's on track to expand, and she moves even to a safer location in 2019. And she's adopted all these modern technologies like till numbers, and she still uses mobile lenders, but she's very clear that they're not putting a strain on her resources. Then on the other extreme, we have Paris, and here you can see the main thing is Paris actually drops out of primary school. She ends up working as a live-in help at the age of 14, gets married at 17, gets a child. By the time she is 19, she has 2 children, an alcoholic spouse. But for her, Fuliza has been a lifesaver. And she uses Fuliza not only for the small payments, but also for big lump sums. For example, she had just taken some credit for her son's school education. So what differentiates Tabitha, Cynthia and Paris is that you see that Cynthia's higher education and the support that she has is what puts her into that path of accumulation through the form of financial, through chamas and also the support she gets from her family. Whereas on the other end, we see that Paris, it's mainly because of her strong financial capabilities that helps her to use the digital finance to maintain her obligation and also to meet any resilience issues. So that, I think, confirms what Bobby said. I think Bobby said at one point that the data shows that it is those that are more vulnerable that are inclined to use the said digital solutions. And then I think Tabitha did take us through the food roller coaster. And one thing we noticed is that it means that the rural Kenyans are also facing the same challenges. There's a squeeze on liquidity, and I think she did say that, the investments in the key sectors has reduced over the years, and one of those sectors is agriculture. So for you to have a business in rural areas, you have to contend with the fact that there's climatic issues, there's seasonality, and also you're dependent on a population that relies a lot on remittances. So when remittances dip, your business struggles. So based on that, we know that running a rural business can be very challenging. And even for young men, specifically these young men who have the support of their families, Evans and Gideon, they have the benefits of inheriting some asset. They have family that can support to pay some of the bills. We see that they're really struggling in terms of making those opportunities work for them. And just to take you through, so Gideon is a young man, of course. He opts to drop out of school in Form 2, opts to drop out because his father can actually pay. And his father then takes him to a Baba school, pays for rent for 6 months. He still stays with his parents. His parents are very core in his life. They somehow connect him, and he ends up being a member of a farmer's circle, and I think contribute some money for him as well. But he's totally unable to maintain this shop. So he keeps closing, and he becomes a dependent, then goes back into business. And you saw Bobby saying that the proportion of dependents has increased, even among young men who should be actually earning a living. So Evans is one of them. Evans, of course, has an M-Pesa to bank. He loves it because he's able to save. He has M-Shwari, and remember, he also has Sacco. Then on the other end, we also have Gideon. He finishes Form 4 and gets into the family business, which is retail. Almost immediately, he gets a bank. Unfortunately, his father passes away in 2014 and inherits the family grocery shop. And during all this time, he has a very successful sister who is always there to support him in terms of business and hold his hand. He's done a little bit more in terms of expanding his father's business. He's put in agency, he's put in till number, but he has a problem with debt. So by 2019, he had loans from the bank, loans from mobile lender, and actually he says that he really can't trace what he did with the money. So of course, in his indebtedness, he then sells the family bull. So I think what we are trying to say is that we are seeing these young men who probably have seen their fathers succeed, or older generation, based on their hard work and many other factors, years ahead, and they are trying to achieve the same. They have very high aspirations, but they seem to struggle to achieve the same. So what is happening is that although they have access to all these financial products and have the capabilities, I guess, to access them and to use them, they're using it mainly for consumption as opposed to capital accumulation. And that, of course, then results in cases where they are very indebtedness. And I think, though we've not looked a lot at young females in rural areas, we speculate that the scenario might be slightly different. They might not have the same backing in terms of productive assets from their family, and they start totally different businesses. They start retailing vegetables by the roadside, then eventually open a little stall in the market, and they don't seem to get into as much indebtedness as young rural males. And I think something we can ask the audience is, what else can explain that trend that we are seeing among our young men living in rural areas? Of course, eventually they'll move back to Nairobi or something. And then the last livelihood journeys is what Bobby said, confirms what Bobby said. Bobby said that the people who are harnessing the most from this form of financial providers are actually those that are in private employment. But even with private employment, we see a difference. We see that it is the public sector workers whose trajectory most benefits from the formal financial institutions. Chamas continue to play a role, even for those who are in formal employment. Although they play the same role in terms of supporting those trajectories, the only issue is the role is smaller in terms of the amount they're able to provide. And also all this is built through social relations. So this is a scenario I think most of you, if you're Kenyan, you understand very well. Someone who worked in the public sector. And Lucy and Regina, entry salary was very similar. There's a whole difference in terms of age, but in terms of the earnings was not a factor in terms of that trajectory, initial earning at first day of employment. Yet Lucy, who worked in the former Nairobi City Council, manages to put up rental units. Yes, they're in Mathare. They get destroyed in 2007 during the post-election violence, but she's still able to leverage on her salary to get more cash to rebuild new ones in her ancestral home. And she's on track on even building more. She's subsequently retired, and after retirement, she then joins a circle purely for social purposes, not that she intends to necessarily save and take a loan from it. And then we have Regina, on the other hand. Regina also works in a formal farm, and she's actually a supervisor. She has 4 kids. She tried the circle, and it was extremely difficult for her. She was unable to repay and struggled. But for her, what really has been working is that she has so many circles. She has daily circles, weekly circles, monthly circles, and that's what she's been able to leverage on. So we see that the use of banks to accumulate productive assets for those who are in public sector is mainly, of course, supported by the fact that they have institutional relationships that can be able to enable them to access these resources. Whereas Regina, yes, might be in a formal institution that maybe for one reason or the other is unable to engage with those financial institutions to get the same services. She then relies on those social relations and her chamas to provide similar security and stability. And another case that really illustrates Lucy is that we had someone else. He was able to educate. He's just a deputy headmaster in a rural school and was able to educate 8 children through university and college, again, depending heavily on his circle. So I think what we can realize is that even those with chamas can still get that liquidity and resilience from their chamas, but what we see is that truly those who are in public sector have so many more advantages that others might struggle to access. So thank you, and I'll get it back to Bobby so that he can conclude for us.
Thank you so much, Carol. So just to quickly summarize, there was obviously a lot of components in this research. Looking at an overall level, looking at livelihood level, we looked at the context, we had Carol with qualitative research. Just in terms of Kenya welfare and financial inclusion, we saw that up to 2016, Kenya had impressive pro-poor growth and it absorbed many into the labor market. We actually saw from Tabitha that the labor market excess sort of labor population declined during that period. And it was led by rural Kenyans where the poverty rate significantly declined. So it was pro-poor growth and also pro-rural in terms of that absorption. This was also a time when both traditional finance and mobile money uptake grew. But since 2016, while Kenya's registered impressive economic growth and has continued to grow, the adult population has swelled, while the sectoral growth drivers have been less labor absorbing. And we've seen now welfare and traditional finance measures have declined. We've also seen the sources of income shift away from farming and business and towards dependency and casual work. In terms of how finance supports livelihoods, we've seen with rural Kenyans increasingly vulnerable, finance does not appear to be a straightforward route to accumulation and improved livelihoods. Pre-existing qualities like social connections, gender, education, they open up different capacities for Kenyans to accumulate funds. And once you're very well positioned, let's say particularly if you have the fortune of being a public sector worker and all those opportunities with formal finance that are open to you, you can successfully accumulate finance and invest in the future, particularly through bank SACCOs and chamas. On the other hand, more vulnerable earning Kenyans, they have opportunities where digital finance actually provides an avenue for survival. It's accessible, it's appropriately designed, and so particularly if Kenyans have better digital financial capabilities, digital finance is actually a way for them to weather the storms of liquidity and resilience challenges. Thank you very much.
Thank you very much, Bobby, Carol, and Tabitha. Thank you. That's fine. That was a fantastic presentation. Yeah, it was incredibly rich and detailed. I think one of our most rich and detailed presentations actually that we have for these deep dive analytics. So that means we have run a bit over time. And so I'm going to ask Jess to come up next, followed by Tabitha. Tabitha, you might want to stay here because yours. And then perhaps I could ask Jess and Tabitha to be a little bit brief with their presentations. Yeah.
Great. It's wonderful to be here. I nearly didn't manage to make it here, so it is great to be able to be here today and be in Kenya again. As was mentioned, we are, us at 71.4 and myself, we've been looking at livelihoods a little bit closer and really just trying to understand if we look at the wealthier and our more economically active segments of the population, are there still unmet financial needs that might be able to be served by the public sector or perhaps through better policies? And I'm going to start with a disclaimer. It's always good to start with one of those, to say that I actually have the easy job here. We've looked at the data, and we can show you what looks like some unmet needs and opportunities, but you all have the harder job in actually taking that forward and doing something with it. Okay, so what did we do? We have taken the entire population, that's everyone age 16 and up, so it's the fin access population, and we've split it into 16 distinct livelihood segments. So these are, as I mentioned, distinct, mutually exclusive segments, so one person can only belong in one group, and we use the main income source as the starting point here. And then using a few other demographic and sometimes sector level variables, we've kind of sliced and diced the population into these sectors of interest. If you see there within the casual workers, we've kind of separated out your older casual workers, so those individuals above the age of 56, and then we've identified your rural and your urban casual workers. Likewise in agriculture, here we first looked at the more formalized farmers. So can we identify those that are selling through more organized value chains, so selling through cooperatives, selling through companies and agencies, other institutions. We've identified them first to say they are more formalized farmers, and they're a bit different to everyone else. So your livestock and your food crop farmers who are selling through more markets, through traders on the side of the road, etc. Not sounding good. Okay. With the business owners, we split the groups here based on the number of paid employees that they have. So your micro business owners, your urban and your rural micro business owners, these are individuals who run businesses but have no paid employees, and they're compared against to your small firms who have between 1 and 21 paid employees, and you can just see quite similar segment sizes there. And then the last one, just to note, is the employed segment. So in the last presentation, the public sector was spoken about a lot, so we've obviously identified them too. And then with the private employees, we've split them out into what we've called more formalized private employment. So those are individuals who have any type of pension product. Okay, any better? I still feel like I sound like I'm in a tin can. Should I just speak? No, use the mic. Okay. Okay, so I was. That's not breaking. Our more formalized private employees, they have any form of pension, compared to the less formalized who don't have any pension. Okay, so with these segments, we've tracked them over time, also just back to 2019. And Bobby and team spoke a lot about these kind of large population trends, and of course we're seeing the same thing, but just at a bit more of a granular detail. So these large shifts away from agriculture, shifts towards dependency and towards casual work. And what's interesting just to note, because I'll speak about them later, is the increase in the share of that urban core casual work. So between 2019 and 2021, that segment has increased by 25%. As a share of the entire population. And within the business owner group, it's also interesting to see that the small firms have increased slightly, but perhaps they're kind of absorbing some of the losses in the employed groups. And our deep dive focused on 8 segments, as we mentioned. Amrik spoke about some of the lower hanging fruit. So here they are, as we've identified them. There are 8 segments, and they've been selected based largely on their size. So they've got good market potential either because they're really big. You can see in the case of your food crop farmers and your urban core casual workers, really big populations. Or they were selected because they have larger than the kind of average population median incomes. So here we're seeing, and I've just highlighted the kind of more highlighted bars are these kind of priority segments we've selected with their median monthly personal incomes reported as per FinAccess at the top. And what's interesting when you look at this from a total market opportunity perspective, so that's just total segment size times by the median monthly income. It's a very crude measure, but nevertheless it does allow us to look at the relative importance of some of these segments, and it shows us some really interesting things. So if you look at the public sector employees, as was just mentioned in the last presentation, quite an easy segment to serve. They're sitting at a total market opportunity at 22 billion, and that's slightly lower than your urban core casual workers who've got a total market opportunity of about 25 billion rand. And of course, not all of that opportunity can be easily accessed and served, and so we'll dig into a bit more about their financial products and services to understand that a bit better. So again, Bobby mentioned that a lot of these segments are very well included already, so I'm just going to focus mainly on the savings and credit side of things. And here what we see, that first kind of line of bar charts at the top, is the proportion of that segment that has any savings product. And I'll show you on the next slide kind of where that savings is held. But what we can see here is that across all of these segments, they have higher than average savings. And it is lower within your kind of food crop farmers and your urban aspirational youth, but still, more than 70% of that population are saving in one form or the other. And although these are quite different segments in terms of their livelihoods, they have very similar savings needs. So liquidity, that's kind of day-to-day household needs, or savings for emergency is really coming up as a major use case across all of these segments for their savings. Education is also a top priority. And some of that liquidity need for business owners would also be kind of contained there within that savings for livelihood purposes. But perhaps it's worth paying attention to kind of the savings for your more wealth-generating productive assets like your housing and land. And we can see this is low across all of these segments. So how can people be better incentivized to save towards these productive investments? And if anyone, we're really only seeing this amongst your employed segments, so very much in line with what we heard in the previous presentation. Okay, and where are these individuals keeping their money? Well, a lot of them are leveraging formal financial services. So here, what we've called traditional is your banks, your MFIs, and your SACCOs together. And we split that out to see the difference between the digital savings. And whilst this is relatively high across all of our segments, what I want to draw your attention to is still the significant amount of savings that's kept within your more informal and your social networks. And still, I think Mary mentioned it, still a lot of savings being kept underneath the mattress. And of course, your more informal and social networks for savings, like your chummers, like Carol spoke to, are incredibly valuable. They're very familiar savings mechanisms and channels. And this is by no means making a judgment call to say that they're bad and that needs to be, reduced. But they are less verifiable saving sources. They're not easily trackable. They're not digitized. And so my question to you in the audience is kind of what value can the private sector kind of add to perhaps take more of the savings into the formal domain so it can be leveraged towards more productive investment. Okay, on the credit front, again, we see quite a similar story in that there is a high usage of any credit product across all of our segments. It's lowest again in our food crop farmers, and as we would expect, lower again in our youth segments, but high within our small firms. So we see 74% of our small firms have at least one form of credit product, and that's the same level that we see amongst our public sector. And again here, I think we can start to see, here we can start to see a bit more of the contrast against these segments. So while day-to-day, using credit for day-to-day needs is a major use case, even amongst these more economically kind of active populations, we also see a bit of credit usage for investment, more so within our business owner segments, and again within our private and our public former segments. And I think what would be great to see if maybe we hear again in another 4 years' time is can we see a bit more of that balance being seen in some of the other segments, so amongst our farmer segments, can we see a bit more credit usage for investment purposes? Can we look at where they're getting their credit products from? Here again, some really big stock differences in these segments. Again, what was mentioned in the previous presentation is your traditional banks and your MFIs and your SACCOs are really only serving the employed segment. So again, it'd be wonderful in a couple of years to see perhaps more of traditional banks, MFIs and SACCOs serving the other segments. Digital is obviously filling a really important gap for the others. We see 44% of small firms are are accessing credit through digital sources, similar levels with our urban micro businesses. But again, a large amount of credit is still being accessed from your more informal and your social networks. And that's fine, right, when you need to kind of tide you over with day-to-day needs. But they become less useful channels when you want to kind of access more larger sums of credit towards productive investment. Okay, so clearly there are some needs, but I'm sure you're sitting here wondering, well, tell me a little bit more about these segments. Who are they? What are the risks in trying to serve them? Can we really try and understand this opportunity a little bit better? And what's quite nice is that I've chosen to focus a bit more on your urban population. So you heard a lot about the rural population earlier. So I'm focusing a bit more on the urban population. And I'm just going to talk you through two segments in particular and contrast them a bit. And that's your urban core casual workers and your urban micro business owners. And you might immediately be thinking, well, these are not your low-hanging fruit because they've got volatile income sources. But again, I want to draw your attention to the size of these segments. And also a really important point that's been mentioned a lot is that the casual worker segment is becoming increasingly an increasingly important segment for the entire population. So given the size and the importance of them relative to the economy, can't really ignore them. Okay, so what's really nice about these two segments also is that they kind of provide a bit of a gender lens. So our casual workers are predominantly males, 59% males making up that segment, contrasted to your micro businesses where it's predominantly females. I mentioned the casual workers are very young, so 70% are younger than 35 years old. The micro businesses are also young, less so, but also we've got 58% there are 35 years or younger. Education levels are not great, so most of them don't have secondary education, but financial literacy levels are decent. So here we're looking at 82% of urban core casual workers can either read a transaction SMS or calculate an interest rate. So some level of financial literacy. And again, just kind of drawing out the median monthly personal incomes. Of course, these are still low, but they are higher relative to the average population. So there is some money there. I mentioned the volatile income flows and the kind of unpredictable food prices results in liquidity challenges. Of course, we know this. It's a problem across the population. It is a problem in these two segments too, and something that you need to be aware of when looking at these segments to serve. So here we looked at just the more severe kind of liquidity metric. So we said, what percentage of this segment have experienced liquidity distress on a daily or weekly basis in the past 12 months? For your urban core casual workers, we see it's at 37%, so just slightly higher than the population average, whereas for your urban micro business owners, it's slightly lower at 30%. And the bar kind of on the right-hand side of that is looking at the main strategy these individuals are using to cope with their liquidity distress when it comes up. And again, the importance of your social savings and your credit mechanisms coming out very strongly here. And this picture alone can't be solved by the financial sector, right? A lot of the stuff that's been mentioned previously in presentations, so bolstering the economy, supporting value chains. Maybe there's a lot of work that can be done with casual workers in terms of the platform economy to kind of improve their frequency of jobs. A lot more needs to be done beyond what the private sector can do to kind of solve this story. But just interesting to see that really the main strategies that these segments are using at the moment to cope with liquidity is either non-financial or social at the moment. And perhaps this is a picture we're comfortable with, right? What we certainly don't want to see, I think it was Gideon, he was from the rural areas, but I'm sure there's a Gideon in the urban areas. We don't want to see more Gideons with a lot of debt distress. It is something that we're certainly still seeing in these segments. So here we're just looking at one kind of indicator of debt distress, whether these individuals have paid a loan late, missed a payment, or haven't paid anything at all. And you can see amongst your urban core casual workers and your urban micro businesses, relatively high levels of debt distress on this metric, in particular. So we don't want to see this over-reliance on credit for day-to-day needs and this debt spiral. So perhaps more needs to be done in other realms, savings, etc., to kind of help with the liquidity management. What will really help with the liquidity management is improved digitization of income flows. So just the first indicator here in the kind of left-hand quadrant, we're looking at the percentage of the segment that are receiving their main income via cash, and it's over 90% in both of these segments. And without visibility on those income flows, it's very difficult for the private sector, right, to understand how to kind of support these individuals with liquidity management and kind of consumption smoothing tools. But they're ripe for digitization. In fact, they are already very digitized, more so than the average population. So smartphone ownership is higher in these two segments than it is for the average population. So it's 49% with your casual workers, 57% with your micro businesses. And daily mobile money usage and making digital payments, again, like Bobby looked at, beyond remittances, is also high amongst both these individuals and segments. So they're very comfortable with digital financial services. Really the opportunity lies here in bringing more visibility into those income flows. And when we sort out the digitization story, we can start to sort out the liquidity story, and then we can really start unlocking some of these individuals' goals and aspirations. And these are highly aspirational segments. So overall, kind of as a group, over 60% of individuals in each of these segments are trying to achieve at least one goal. And what's interesting is that many of these casual workers are trying to get into business. So they're really trying to kind of move towards some upward mobility. And the question for the public sector and the private sector is how can you support that better? Because again, what we see here is that the main strategy being used to achieve these goals is largely non-financial, so kind of cutting back on expenses or working more. Social savings and credit is playing an important role here, but what we'd love to see is a bit more from the traditional space, so that's your banks, your MFIs, and your SACCOs, really working towards supporting these individuals towards productive investment, to again, move towards more upward mobility. Okay. So I'm going to leave it there. This was really just a snapshot into two segments. We'll be doing profiles for all the others. But yeah, thanks very much.
I think Tabitha's going to briefly take us through some stuff on MSE Tracker surveys.
Yeah, thank you, Rick. So we want to look at how MSE Tracker surveys can inform policy and the insights that you can get from data that we have collected. So I'll start off with the 2021 FinAccess survey that found livelihoods due to business, or people who are doing business, has declined. And just as a rider, we collected the data for 2021 FinAccess in September, between June and September 2021. And one of the elements, it could be maybe due to an impact of COVID. So these are adults aged, or persons aged 16 and above, earning an income from business. The reason why I put 16 is there are people who are already in employment at that age. And that proportion also, there's a significant proportion of women in business. That is 57% in 2021. Compared to 52%. This is, of course, coming from an earlier research that shows that the proportion of men, in the last, when we were launching the FinAccess survey and some other workshop that we had, that men also are affected by, disproportionately more affected by COVID. So from also the FinAccess surveys, there was a general reduction in incomes from all different livelihoods, but especially from persons in own business, running an own business as a main source of livelihood. So MSEs experience more risk in terms of income, and we would want to track how they're affected, for example, by the business environment that they're operating in terms of course, the impact on revenue and employment. So what we're showing is that for the employed, the casual, agri, they were affected, but it was disproportionate to it was their own business, people operating their own businesses were more affected. So the MSE tracker that we want to highlight now was one we did in 2020. It's not it was before the FinAccess survey. So what happens is when you do the FinAccess survey, we would request all persons to give us their numbers and consent for follow-up interviews. Those are the ones that we target. So the initial sample, we had 3 waves that were conducted over the period, and the sample, as I'll indicate, has declined over the 3 particular waves. And of course, we had some completed interviews over the 3 waves, was around 73%. This is what I would want mainly to focus on. The first wave was in November 2020, just after, that is the wave of the data collection. When we had come out of some easing of the COVID, we tried to do some data collection on how they were affected. And then the second wave was in March 2022, not the wave of COVID, our wave of collecting data. You know, there are waves with the COVID. And then the final one was in July 2021. So the focus was on people who were operating a business before COVID, that was in February. And then if they were operating a business in February, we asked if they were collecting a business in the second wave in March. And we also looked at those who were operating then and who had closed after COVID. So 347 respondents were present in all the 3 waves. And what it shows in the bubbles is the particular, in the first wave, 262 persons operating a business, and 84 were not operating a business during the first wave. And as with panel studies, there's an element of attrition as you come across, either through lack of participation, they don't want to do a follow-up interview, or you are not able to contact them again. So that is the analysis that we base on. So what did we observe in terms of, and what are the main takeaways that you can see from this follow-up of MSEs? Why is it important to conduct this? You are better able to track some of the key indicators and show the implication of policy. For example, when we are having this, when we are doing these particular waves, there are particular events that were happening. Just in November, when we did the first wave, there was a slight easing, but in some places, some borders had not reopened. Some policy interventions had not completely been removed. We are still experiencing the reduction in the removal of the transaction fees, for example, at that particular time. And you're able to see, and of course, the element of people did not want to handle cash just at the height of COVID. But after, for example, when we were doing the 3rd wave, then things were different. Similarly, when we were doing the first period, there was those roadblocks, for example, preventing inputs that are key for some MSEs, like those who are in wholesale and retail, mama mboga, as you would call the vegetable, where we buy our vegetables, and some other supplies. So what did you observe, for example, in terms of customer demands and in terms of employment? MSEs are also employ a significant proportion of the population. There are those that are 1 person show 2 people, and there are those that have enough staff. So we focus on both the paid and the unpaid employees. So in terms of the changes over those phases, in February 2020, which is the first on the right, 75% of the MSEs had paid employment. During lockdown period, which is one of the reference period, it dropped. The proportion of business with at least 1 paid staff member dropped from 25% pre-COVID to 19% during the COVID period. It's the reverse. 25% had paid employees, which reduced to 19% during the height of the lockdown. In November 2020, when we collected the data for the COVID period and the pre-COVID, this had also was at 22%, showing the post-lockdown effect in terms of employees. In March 2021, there's a drop from 463 business owners that responded to 289, but in terms of proportion, 38% that had recovered a bit. And again, in July 2021, that was just 24%. So those who had those with unpaid employees, we show that we are able to indicate that in terms of the labor absorption and the labor demand for MSEs, those changes that are there during those three phases that we collected the data. The other important component that we are able to assess in terms of revenue patterns during that period. So the February 2020, before the COVID, is like an index of the changes in revenue. We started, of course, the one, and then in lockdown, April to July, the period when there was not much movement, and then up to 2021. So on average, during lockdown, businesses only earn 38% of what they earned before COVID. And that because of the easing and the changes that happened in terms of policy and also the reopening, there was that increase. But at the end of July 2021, active businesses that had not closed were earning 16% more than what they earned pre-COVID. This kind of analysis is only possible when you're doing the tracker and you're following the same type of businesses to get the insights of what actually happened during these phases. Whereas the attrition is there, but at least you're able to tell the attrition in terms of the numbers of MSEs participating in the study. You're able to properly profile these particular categories of MSEs, both, for example, that are women-owned and those are men-owned. And this is maybe when we finalize, I'll direct you to a particular report that also we have highlighted, we have uploaded in the website of the three institutions, and get more insights from there. So from these patterns, you are better able to segment and see the implication of the changes and how MSEs is able to navigate the particular shocks and events that are happening, and how they're able to, and this enables us to tell good narratives that inform you users of data what is coming out. And we're able to come up with like 7 segments in terms of revenue estimates. There are those that MSEs, and this is also across particular sectors or clusters that you would say, that there was a continued decline. As much as, for example, previously the general increase in revenue across MSEs, but there are some that had a continued decline, for example, before COVID, that is the lockdown period in November. There are some that totally went off and closed down. There are some that even recovered, and some that were not much affected, that stayed the same. Some bounced back to what they had, closed during COVID, and very little, but they were able to recover in November. And these patterns let us give face and inform the users of this information in terms of the segmentation, especially for particular categories of MSEs, the sectors, which is detailed in the report highlighted, and there's also some good qualitative work that has happened with that. And from the last wave that we did, we're able to segment the MSEs that participated across like 3 broad segments. The ones that recovered, the struggling businesses, and those that totally closed, not operating a business in 2021, like they were totally affected by COVID, where others, they struggled and they're still operating, and some, they have like totally recovered. This provides a rich analysis of what you can do with the data, what you can say much about MSEs in terms of the effects of particular aspects or interventions. And this, just to mention that when you look at the reports that we have uploaded, you're able to, even the issue of digital support that was there, or how they used the digital solutions to navigate the COVID, and also other elements like borrowing and informal support that they received. So in terms of what we saw is that among the recovered segments of the MSEs, those were the more digitally advanced than other segments of MSEs. And this information is crucial so that you can see the element of, for example, the ones that among the struggling recovered in terms of the use of payments. In terms of the struggling, only 65% were using digitized payments only, and whereas the recovered, it was 35%. We have, like, we categorize them across these particular segments. There was an issue of digital marketing and what we are calling digitally advanced. They accepted digital payments and used at least one digital marketing channel to reach customers. Because at that particular point, when you had COVID, everyone was like at home, but they could call, use WhatsApp, Facebook, or whatever forms. So the ones that could harness those particular solutions, those particular options that are there for them, the ones that quickly adopted different payment channels, you know, at that particular point of COVID, you could see that explosion in use of digital payments solutions. Yeah, thank you so much. The reports are available in KNBS website, FSD, and Central Bank. Thank you.
So I think the way we're going to structure this section, I'm going to ask the two panelists for their initial thoughts, and then ask them some questions, and then we'll open to the floor, because I know all of you have a lot of interest in getting insights on this. So I think our first panelist is the CEO of the SACCO Savings and Regulatory Authority. And so he really has oversight over the SACCO sector. He has over 23 years of experience in the sector, so I think getting his views and insights on the data will be useful. And of course, we have Ritu Muridhi, who is an economist. He's a well-known face. I think he was a former governor, and he's also worked with multilateral institutions, such as the World Bank Group. So I think it will be quite useful to get their insights. If you see me looking at my phone, it's because that's where the questions are. It's not because I'm distracted. So I think I'll sort of just start with you, Peter, because you do have that regulatory oversight of the SACCO sector, which I think we saw come up many times. I think my first question for you would be, what are your key takeaways, particularly in terms of the segments that were highlighted? I think you saw Jess and some of the others talk about the key segments, but also just in terms of the sectors that we've seen that are quite active. You know, where does that sit for you as a SACCO? And what has been some of the impact of COVID on those sectors and segments?
Thank you very much for that question, and for the organizers of this. Now, let me commend the team that has put together this work. It's, I would say, you know, excellent piece of work, digging deep into this data. I think we've been stopping at the data, but I can see increasingly we're getting better. And I think for me, the challenge it comes is that we have a regulatory framework where we focus on stability, and therefore you just get the balance sheets and all that aggregated figure for the industry. But above that, if you look at the financial sector development plan, there is also a component of inclusion. So how are this industry and all of us impacting on inclusion? And also the other dimension is efficiency. And I think this, going deeper into this, challenges us to go beyond the headline numbers that we see, because it's very easy for us, SACCO industry, we've seen double-digit growth over years, even during COVID, post-COVID. Headline figures is industry aggregated figures. But I think now we are saying, if it's loan asset, we are talking billions, now approaching $1 trillion, what sectors is this going into? And we can clearly see it will be very unfortunate from this data for us to sit plate and say, the formal financial institutions really that, we are doing a good job, kudos. Because the underlying sectors are actually bleeding. That's really what we are being told. And I think looking at the structure, and I think that what I like is that the Kenyans are on digital finance, social network, finance networks, and they are surviving, you know, but are they, you know, accumulating assets for the future and all that? The answer is apparent, very, very clear, it is a no. But those segments, and then the fact that you looked at the performance of the economy over that period to see what are the root causes of this, I think that's very well done. and the structure of the economy. And I think for me, it's very apparent we have the agriculture industry, service industry, finance sector is actually a service sector. But it should be designed to serve the real economy, the industries and the agriculture. Is it doing that? The data is here to speak to us. Again, challenging us as financial sector players. Are we designing policies that try to incentivize the players to serve the real economy? Because if agriculture is doing like we are saying, employing less, productivity is coming down, even people in farming are moving towards dependence, then we have a serious problem. And yet, agriculture, any economy, food security, all these, we cannot. Industries, most of them rely on agriculture for inputs. So I think there are fundamental questions around there about the impact of financial sector. But I think there is hope, looking at the opportunities ahead. I think a good job has been done there as well, and pointing very clearly what are the low-hanging fruits. It's a challenge, and I think looking at the data we collect, and perhaps I'll respond to that in second round, there is a lot of work to be done. But fundamentally is to ask, is our financial sector designed to serve the real economy as it is structured today? And for me, it's sad because combined, I think we are over 70% of the GDP. I think currently at 12. If you look at the financial sector, the assets we are reporting are, near 70%. But where are we putting this money? It's not evident in the real economy, and except for a few organized, say, agriculture and all that. And we seem to be growing big on service sector. Now, whom shall we serve if the real economy is generating income? That's a big question for us to think as we design policies. No easy answers to it at all, but it's a conversation that has started. Thank you.
Thank you, Peter. And I think that's absolutely the question in the spirit of this conversation. And so, Ndirita, I really want to ask you, obviously, for your insights as someone who really had oversight over counties, really giving your insights on what was presented, but also giving us the lens at the county level, what you saw in terms of the financial lives of people at county level in particular.
Well, thank you. Well, I'm a bit anxious because, Tabitha said devolution was one of the structural problems that has led to this decline on all the welfare measures. But more seriously, I think, and this is fantastic data, I think the next step perhaps is to look at what is happening on the productivity side. Because as my colleague is saying here, the financial sector is, finance or whatever, it's enabling exchange. So if productivity is not improving, it is likely that, welfare measures will in fact then either be stagnant or declining. And if you look at the data on real wages, even in the formal sector, there's a general stagnation, I would think, for almost 12, 14 years now. So the question is, what is this that governments could do to stimulate improvements in productivity? In our case, in Laikipia, we have a couple of samples that could provide perhaps some insight as what could be done. So, in one sample is about 1,600 small businesses that we did something with directly as government to intervene to see how can we improve productivity. And another sample is about 600-700 businesses that were accessing finance because we were doing something. So I would say that that's my take on the whole thing.
I think that's a good point. I think the real economy, I think from a liquidity point of view, the financial sector has to be serving what they view as productive activity. So I think that's a key disconnect that we're certainly seeing. So I think I'll just ask you, Peter, on this is, we saw that the use of SACCOs, and not just in this presentation, but in FinAccess generally, it has been declining over the years. So what we tend to see is that for those who do use SACCOs, it's very valuable. But the feedback we seem to be getting is that there's a lessening popularity of the segment, even as the asset base grows, to your point about not reaching as deep as perhaps would be preferred. So it'd be really useful to find out from your position as a regulator, what is driving, this relative, aggregate decline in sort of the relevance of SACCOs to Kenyans, but also, what sort of key activities and strategies are you using to try and make that a really relevant use of finance? Because when it is useful, it is transformational, is what we often find.
Thank you. I think I would say that one, in the FinMark test, there were reasons as to why SACCO's popularity is declining, but I'll speak to what the data actually has indicated here, that SACCOs serve the formal employed people, both private and sector, that they thrive in that. That has stagnated. Two, they also serve organized value chains. When you go to tea, milk, and coffee, they are big time. When you go to horticulture, that market is still not very organized. There are efforts, but it's not yet really there. And therefore you find, and then you go to MSMEs, another segment. There are efforts, but I think that again. So I think the question is, SACCOs were founded on these key value chains and then employed people, and with that segment then declining, you will expect naturally their market. However, they are trying to actually open up. I'm sure the former governor will confirm, like in his county, all the SACCOs there have rebranded. If it was a teacher SACCO, it is now having a name that appeals to the general population. But again, they are attracting these MSMEs, this market where, again, they are not used to, what I would say, the market is not very organized. So those challenges could also come in because lending to that area, so meaning that there is work to be done in lending to MSMEs. How do we, do that? However, the numbers we have collected over the same period, I think 2015 to today, actually show the assets for the SACCO industry have actually doubled. Membership has also doubled from 2016 to actually 2021. Again, telling you the paradox that relative terms, they are not reaching out, there's more work to be done, their popularity, usage and all that, but all the headline numbers are growing. And now and even including the membership they are serving is grown as well, doubled. And I think that now raises questions to, again, look at this, because those who public sector, like shown by the numbers, if it's coffee farmers, tea farmers, they are still faithful to their institution because they have been able to create history, accumulate assets. But I think the question is, as you indicate, are these number declines of these people, then what happens to the SACCO? Where will they recruit members? And I think that's what we are saying, the productive area, we have to do something so that other people can transition in the income ladder and then become credible. And the question is, which tools do we require to support them? And I think that's what the last presentation opportunities that are there in that segment, that's where for me I saw the low-hanging fruits.
Thank you. That's a really good point, because often if an industry just looks at its own performance, it will have a very different story compared if you look at it from a macroeconomic perspective. So I do want to ask you, Dirito, about the devolution question so that you can highlight, because it is something that we are very curious about. So in your view, what ways did devolution improve the financial inclusion, financial health, and economic opportunity? But also in what ways did you frankly see it didn't really help? It would be really useful just to get your insights on that.
Well, I think it did help. You see, even from a normal economics conversation, decisions should be made closer to where they are required. So if you think about efficiency, say, in the public sector. So for instance, if, a neighborhood, path or footbridge needs fixing, if that decision has to wait for a person who is in Nairobi, then it will go unfixed for 3-4 years. So I certainly think that it has helped. Casual observation would also point to the same. If you go to most areas where, say, rural infrastructure, for example, roads, whether, improved roads or just gravel roads, where they would not have been and have not been possible, for all the years before devolution. I know that, for example, our colleague Tabitha talked to the question of agricultural extension, but you see, the extension officers were devolved, so it's not that they left the service. So our, and I think there is some actual analytical work with the COG and others that does show that there were improvements. But could we say devolution has improved financial access? I think that would be somewhat of a stretch, because the financial access was improving generally, and financial inclusion was improving generally, mainly, in my view, because of digital and mobile phones, and that was across the board. So and I think finally, devolution presents the possibility of multiple centers of growth, which has again been a traditional question in the Kenyan context, whether are we growing across the country, or are we growing only maybe in the major centers like Nairobi, Nakuru, and so on. So I think devolution presents that additional possibility, and obviously county governments are able to intervene, albeit at a smaller scale, in terms of what is happening with the economies.
Wonderful, thank you so much. I think now we now open the floor, and I think when you ask the question, please give your name and your organization and who you're asking the question to. Of course, you can direct the question to the panelists with their rich wealth of information, but also you can direct your question to the presenters that made, so that we have at least 10 minutes of questions from the floor. So is there a mic? And I think you can just raise your hand, and then I think we'll start with Prof at the front, please, and then we'll go to the back. Please do just state your name and your title for record, and who you're directing your question to. Thank you.
Thank you very much. Thanks to the presenters. I must say I've really enjoyed the session. Very insightful data. Thanks a lot to the panelists as well. They've given a lot of good insights. So my questions are directed to Tabitha, first of all, in her presentation, and then Bob as well. So first one is related to crowding out, this crowding out narrative. I think this is a narrative that Tabitha stated that you can actually see crowding out, and crowding out has been increasing, but actually you see a lot of evidence of a counter narrative against crowding out, because crowding out assumes that as the government is borrowing more, you have larger budget deficits, interest rates are rising interest rates actually lead to lower growth of credit. In fact, you've been seeing the opposite happening. Even in recent months, the last couple of months, you've actually seen credit growth going up. The budget deficit has actually been falling. If you look at that, government has actually been diversifying its sources of borrowing. So initially there was very heavy domestic borrowing, let's say a decade ago. And in the last 5 years, you've actually seen a balance between domestic and external borrowing. So in fact, there's been less pressure on the domestic market and a substantial increase in external borrowing, so that you have domestic and external borrowing actually at 50-50 almost. So let's just say you don't really see very much evidence of crowding out. So I'd really challenge that narrative that, yeah, we've been moving towards a lot of crowding out, and just say that actually the statistics tell us otherwise. Even in recent months where, because of tightening of monetary policy, the interest rates have been going up gradually as you have monetary policy transmission through the economy. You've still seen, with the exception of a small dip probably around August, you've still seen private sector credit broadly still trending upwards and really recovering. So I'm just saying there's a lot of evidence that actually from the data that challenges this crowding out narrative. So it's something we need to explore. Also, second issue sort of that struck me was on exports contribution to GDP actually falling. I think there, from an econometric point of view, you have to consider that we had a COVID-19 pandemic in 2020, so there was a structural break. So you can't really, if you're looking at the evidence in 2020, 2021, seeing exports to GDP declining, that's a different relationship from what you had prior to that, because of course that was a global shock. Incomes fell very substantially all over the world. You'd expect countries that are exporting, especially diverse exports like Kenya, you'd expect some decline in exports. So just saying that, again, I would challenge the narrative that that exports, that you really have a sort of long-term decline in exports to GDP. In fact, there's a lot of evidence to the contrary. When you look at disaggregated data, you actually find that exports are becoming more dynamic. We're expanding our let's say markets. We're expanding export products. We're increasing export product complexity. So I think there's been a lot of dynamism in exports. So just looking at that one number can be really misleading, because it actually doesn't go into sort of the disaggregated story of export dynamism. In fact, exports in Kenya have actually been much more resilient even to the shocks of COVID-19 and the more recent shocks we have from the conflict in the Ukraine than in many other countries. Even our most recent export statistics show year-on-year growth of about 11%, which is actually much better than many of the regional peers. So just saying that, just looking at that one number and saying that exports are actually declining relative to GDP, there are a lot of nuances there that really one has to look at. And one final point is just, this is on Bobby's presentation. Again, very interesting statistics there. But just I would raise a research question, which is, when you say, well, we did some econometric analysis. Based on the econometric analysis, we found this causality. It's really not enough. You have to give much more detail about what kind of econometric analysis, what sort of estimation methods were you using, how did you address key microeconometric problems like endogeneity, reverse causality, how did you address, these are sort of the fundamental things you want to address when you're bringing out causality. When you're looking at the descriptive part and you're saying, okay, these are the sort of trends we see, that's fine. But once you get into causality questions, then now you need to give much more detail. I'm assuming, of course, that there must be some sort of underlying inferential analysis that's quite good, but I think some of that has to be sort of brought out, even briefly, just to give a sense of how did you arrive at those causality relationships. Otherwise, people could question that. So those would be some of my sort of preliminary comments, but otherwise very excited about the conference and the discussion and the insights. Thank you.
We'll collect a few questions and then allow for a response. I think there was a hand there, there's a lady, and then there's a gentleman in the back. Is there a mic that we can, oh, sorry. I think there's the lady there, then there's a gentleman in the back, and then after that we'll allow the respondents. Name and institution, please.
Thank you. My name is Judith. I am from Kipra. My questions are brief. To the presenters, especially the first set of presenters, a very rich presentation, but with very many moving parts, and I kept feeling like if we were to put government officials in this room, what will we tell them? So the need to tease out the policy recommendations is very key so that we can be able to know what are the pressing problems that we can address to make Kenya move forward. And just to give an example, I saw our statistics about the learning poverty, where maybe secondary school education could be there's a higher learning poverty at secondary school level than primary school level. And recently we just saw an overhaul of primary school education. So I thought maybe some of these things which are coming out could actually, well articulated, could actually inform what the government is doing so that we can address the key problems. Then the other question is just one to ponder on about dependency, increased dependency. And I was wondering whether there's any relationship, if so, between the increased mobile uptake and dependency, more especially that we are able to borrow as and when we can. Also, when you're looking at that particular aspect, maybe somebody could be thinking about how Kenyan, not even Kenyan, African culture around the need to support our siblings. We saw the report for, is it George, who always squandered the money and expected the sister to support. Then what does that mean to our economy? And this is, I think, largely African. And then the other question is the story of Lucy, where Lucy is able to, was a former public, I think, servant, and was able to get money to build some rentals somewhere, I think maybe in Syokimau or so. But then the question is, the Lucy of today is working the public service. Does the story reflect the Lucy of today? Why? Because of the rising gig economy, where, in fact, the people in the informal sector, I don't have, statistics that I can point to, but we can clearly tell that they earn more. In this sense, even the president the other day was saying, we are seeing a lot of, we are seeing minimal collections per carry, yet there's a lot of transaction, money being passed from one person to the other, especially in the informal sector through M-Pesa. So maybe the Lucy of today is not a public servant, but is one in gig economy. And I think that will really inform where taxman should be looking at. Yeah, so I think those will be my contributions for now. Thanks.
Thank you. Please remember to say who you're directing the question to so that they can prepare. So I don't know, was that to Jess or Tabitha or?
It was the first set of presenters.
So I guess Bob and Tabitha. Okay, we have a question in the back.
Yeah, thank you. So my name is Kefa Simi, a student at the University of Nairobi. And my question is directed to Ms. Carol regarding chamas or self-help groups. Yeah, because from the presentation, she had hinted at them being beneficial, particularly to women and the youth. However, I have realized that most of these chamas, they never last. So, based on what you have been working on, what insights can we carry forward in guaranteeing the longevity of these chamas? And lastly, I would love to hear whether you have been able to maybe track down some of these chamas for the past 5 years so that we can have an informed understanding of the issue at hand. Thank you.
Thank you. I'll allow the respondents, and please, panelists, if you have a response to the questions, please free to jump in. So I think allow the first round of responses. Can you just bring the mic to, yeah.
Okay, thank you for your comments. I will start by saying first that what we presented is an extract from a larger paper that has been done. On the issue, okay, I'll go now one by one. So the context of what has been extracted, some element may be missing, and probably the gaps in the communication. On the issue of the crowding out, Prof, I think we look into how we are phrasing our narrative and appreciate your comments. On the table of, there's a chart where we're looking at the issue of exports. Again, in the main paper, we are looking at the exporting, especially for the way the paper is, we are looking at the livelihoods. So we are looking at the core exports, the particular, especially in agriculture, that employ significant proportion of labor, casual labor. So the key, I mentioned the issue of the key crops, although it's not in the presentation, tea, coffee, sugarcane, and horticulture. They employ a significant proportion of the population. So that was the context of that. So lower earnings in those particular exporting sectors is I think is a lack of disaggregation in terms of the key exports, in particular the ones that employ the key crops or key particular products that employ a huge labor. That is what is missing in the presentation, and will that is highlighted in the broader paper. So that was the context of that slide. But it's true that there is a diversity in our exports, in the composition of our exports. I think those were the key points directed to me. I don't know that my colleagues.
Yeah, thanks very much, Prof. And I think what you've highlighted to Tabitha in terms of the sort of contextual economic work, it's really important because we were observing some patterns that were taking place particularly after 2015. And of course, as Tabitha pointed out, the credit cap had a very big impact, maybe not in crowding out, but certainly in a reduction in private sector extension at the time. I'm glad to hear that there's a recovery, and hopefully, as Tabitha is saying, the focus of that recovery, whether it's export-based or whether it's domestic economy, is in sectors that are going to be greater employers of Kenyan labor. If that happens, then hopefully we see some of the reversals that we were noticing on the livelihoods perspective. And I think from a policy perspective, that is really important. It is important to have complexity and that complexity is labor absorbing. And then on to the second person who was posing questions, I agreed. Like we can improve in terms of the policy implications and the education as well. Some of the things that Tabitha was detailing is, I suppose, reduced competency as people are moving across grades. But it isn't just that maths and science is going to prepare people to be absorbed in these sectors. As you're saying, with primary school, with primary education being overhauled, and hopefully that takes place, the economy is increasingly becoming more complex. The requirements, especially in terms of digitization, for people to be employed, are such that the education system needs to keep adapting to prepare people to change the relationships where, let's say, ICT and insurance and financial services are not employing that many people because the skills that are required are not as prevalent in terms of the throughput coming on. So, yeah, that's a really key point that's being raised. In terms of Prof, on the limitations on our models, agreed. There's more that needs to be communicated in the paper and could have been communicated today. I think one overall thing is that compared to some of the other research that's being done, when we've just been relying on the FinAccess data, which is cross-sectional, it's not panel, doesn't follow, it doesn't have an experimental design, it's definitely limited in terms of the insights that can be made. We can show it. A lot of what our insight is descriptive, and it's descriptive with a little bit more. So sure, we did some pseudo-panel econometrics to show that there are relationships between people that are vulnerable and having lower welfare and digitization expansion. And our narrative on that is that it's not digital products that are causing people to have lower welfare. It's really that they're supporting, that they are helping as safeguards. At the livelihood level, we did some propensity score matching. But the propensity score matching is limited by the number of characteristics that you can actually control for. And again, I think FinAccess is, it's not that at the very start of FinAccess design, these kinds of research questions were thought of. So there's going to be limitations, and particularly with propensity score matching, as you were sort of alluding to, it's only as good as the characteristics that you can control for. And I think for a lot of the things we're looking at, there are limitations, but it is something for future FinAccess studies and design that can only enhance. As FinAccess has added so many important areas over time, it's just something more. In terms of Some of the other policy questions from the second questioner, on mobile credit uptake and increased dependency, that's a very good question. I think just as a continuation in my responses to Prof, I think we'll probably be limited by the data in terms of being able to identify very strong causal relationships as in terms of dependency and relying on siblings. But as you point out, they are really interesting research questions to continue exploring. And in terms of who will be the Lucy in the future, I think that's a really important question that expands on the sort of structural changes we're seeing. Even if the Lucy, is it even the case that the Lucy in the present, let's say a public sector employee is going to be able to leverage their access to SACCOs and traditional bank credit to have the same kind of trajectory that Lucy, who started in 1999, will have? It's a very important question. And then for someone in the digital gig economy who doesn't have that kind of access to SACCOs and to banks, will she have the same beneficial trajectory? Hopefully that will be the case. And I think that this session is helping us to identify the kinds of support and changes in the financial system to enable that to happen. I'm going to pass over to Carol for the last question on chamas.
So thank you for that question. So I think the first thing to consider is what really makes people come together as a chama sometimes is not necessarily about getting credit or saving, it's also your social support network. I think many of us have chamas with our family members who default, and we've never left that group, isn't it? And also we have to appreciate that chamas realize that those are the challenges, and they're evolving and innovating. We have many chamas now that operate as askers, meaning at the end of each year, they then share out all the finances and ask members who want to rejoin to start afresh. They're also adopting other tech ways of ensuring that some of those issues they do face are addressed. And it is true, maybe chamas fall out, but as we know, as women, we exit one chama and tomorrow we've joined another one, isn't it? So I think they do serve that liquidity issue. Whether or not they're able to serve it for a long time for the same members is what might not always be clear, but there's always the option of exiting and starting afresh.
Thank you. I think we'll allow final comments and then close. Go ahead.
Yeah, thanks. I wanted to respond to the question Prof raised. Is there no crowding out? And I would give an analogy. Supposing the Prof and I are running, let's say, in a sports field, and he is in his lane, I'm in my lane, but he's running 5 times faster than I am. I suspect he'll get to the finish line earlier than I will. Now, yes, private sector credit or credit to private sector is trending up, but it's trending up at 3 or 4%, whereas credit to public sector is galloping away at 15, 16%. I would argue there is crowding out because the speed of change is way faster on credit to public sector. On the question of what is the policy takeaway that our colleague asked, I would see plenty. I mean, for example, out there, we are debating something called Hustler Fund. I mean, what problem exactly are we solving? Is it a lack of access to finance, or is it the kind of access? Is it the channel? So I would think looking at this data will help my colleague here from SASRA and others who have to design whatever that fund is going to be. So I would think there is plenty of insight that we can take away from this. And finally, 15 years ago, I think at the time all this was starting, or even earlier, it was thought that access to finance was sort of the key to unlocking, growth in wealth. But what this data is showing is that we may need to rethink that. So I think there's plenty of policy takeaway. Thank you.
Thank you. I think I want to add, there are many policy questions that come from here, policy lessons indeed. And one of the questions, especially the opportunities looking ahead, the micro and small enterprises, you realize that from the data you can see lenders are are opened to markets or segments of the livelihoods that are stable, predictable, and easier to deal with. So in these micro, small SMEs and others, one of the questions is how do they organize this? He's talking about chamas having a high mortality rate. But I think one question that keeps revolving, if it's horticulture and other segments, even, look at our public transport system, how do we organize it such that it is attractive and sustainable, even from financial perspective? And I think that is where, if you look at what informed some of the farmer-based circles you find in the counties, is because there were a way of organizing those people. Now today, horticulture farmers are starting, and there is, organizing them is becoming a challenge. If it's, Matatu, we know we came with the policy of transport companies, transport cooperatives, not circles, transport cooperatives, but still, it's like we back up. And I think those provides opportunity where an industry, a sector is organized, then it becomes easier because there is we say, there's this term in economics, we talk of the failure of a market. And if industry can coordinate itself for its own good to address not just capacity, access. And for these emerging MSEs and all that, what opportunities there to be structured, organized in a way they can converse with the financiers, with the government and all that for their own sake. Because a market that fails to recognize that over in time, you cost it to access credit, difficult to interface with the government, market access becomes issue, quality standards become issue, and that now seems to. So even as we see the opportunity looking forward, I noted digital was highlighted. Remember, digital is still service. What are we doing about the productive economy? So I think I see policy conversations around there. How do we help those farmers, because they don't know about market access? We collect the data. So there is huge opportunity there, like she asked. I think the data talks to the other side where the productive sectors, policymakers need to see, because finance sector can only thrive when the productive and other sectors also thrive. So there's room for conversation there to see what needs to change. And I think that's part of what, as we deepen financial inclusion, we need to see how do we as policymakers have that conversation. Because I think someone said yesterday, there is a lot of silo aspects. How do we work in a synchronized way? Because we know capacity a question, market access is a question, standardization is a question, so that when they produce or they offer service, there is a level of standard that will make their products competitive and possibly improve incomes moving forward. And that way, we'll see the impact down the line on the financial sector. So those are open questions that really need to be asked, even as we say there are opportunities here. Thank you.
Thank you very much. I think we'll close this segment of the session, and thank you very much to the panelists and to you all for your questions. I think if you have follow-up questions, you can try and find the person and corner them.